There it goes. If you have not found our YouTube channel, jump on YouTube, search for Planning Before Investing. We'll also try to get a link out on this as well, but it may take a little bit to get that all put together. We will get it on here though, and it will be available for rewatching. Again, jump on YouTube, search for Planning Before Investing, and you will find this wonderful page with over 300 videos, and we're at 16,500 subscribers. We try to put new content on here all the time. We've got every topic we can come up with on here. I have also been working hard for the last month or so on creating a new topic. For those of you that are familiar with my educational classes, the nonprofit organization, Foundation for Personal Financial Education, next month's class, May's class topic is all about inflation and handling inflation in retirement. So, somewhat related to what we're going to talk about today. Jump on our nonprofit website, fpfeaz.org, and you can find our full class schedule on there and register for those classes. Lots of opportunities to view the class on handling inflation in retirement. We always have a different class, a different topic every single month. And then lastly, our company website, Secure Estate Solutions, sesweb.net, sesweb.net, has lots of wonderful content on there, especially under that education tab. You can also schedule free meet and greet appointments on there as well. All right, let me see if I can get this switched back to Grayson, and we can probably get going soon here. Stop share. Grayson, go ahead and share your screen again. If it popped back up, everybody can see the screen the way it looked. Yeah, I think it looks good. Well, Grayson, you think we're ready to get going here?
Good.
I think we had almost 30 respond and say they were going to jump on here. Um, so we may have people jumping on. There's always time zone issues when we do these things as well. Confusions on which side. So I guess let's get started, especially with the class that I'm teaching next month. I feel like I've been talking about gold and how to incorporate it in a portfolio from a advisory standpoint. And historically, it's always been kind of throw it in gold, physical gold, go buy the expensive physical gold, pay the premiums for it, and let it sit in your closet and not do anything for you, or buy what we've always called paper gold, ETFs, GLD, things like that, or even mining stocks for some people, which historically have had quite a significant disconnect from the actual price of gold. So luckily, we have one of the pioneers of the alternative way to invest in gold and actually start earning on gold. And that's something that was always intriguing to me, watching central banks do stuff like this, which I'm sure we'll get into today. And why couldn't we do things like this? And all of a sudden now we can. And Grayson is somebody that's been in the lead of this, in the front of this, for probably close to a decade now. And it is a wonderful opportunity, and it is something that we're going to dive into headfirst today. So, Grayson, why don't you jump in and take this away and get us started here?
Absolutely. Can you hear me pretty well?
Yes.
Okay. So, like Scott said, the history of investing in gold has typically been just buy the gold and put it in your closet or your basement, or buy the mining stocks. So we're going to go through some things today that are talking about a lot of differences. That's basically a new evolution of investing within the gold space. Okay, so just going through a couple of disclaimers, but the fact of the matter is there is a new evolution in gold going on as we speak, and it was born of a while ago. But let me just rewind a little bit and set the stage for where we are right now in the investing landscape. When we're talking about gold, anytime you talk about the last 20 years, which is a number I simply picked out of the sky for this presentation, anytime you're going to talk about a 20-year time frame within the financial matrix, of course, you're going to talk about the S&P 500. So if you started with $1,000 in the S&P 500 20 years ago, here's what the performance looks like. And this is the SPX TR, which means total return, including the dividends of the S&P 500. Pretty impressive performance, right? I mean, you started with $1,000 and you end up with almost $8,000. Pretty good compound annual growth rate, as they say. Maybe a little bit of a surprise to a lot of people is going to be just simply the performance of the price of gold in US dollar terms. You notice a few years in the last 20, basically the first decade of that, gold was performing better than the S&P 500 plus dividends. You know, a lot of the second decade of this underperforming. However, you know, within the last 18 months or so, the S&P 500 plus dividends and gold have ended up in pretty much the exact same spot over the last 20 years, $7,500. But the reason we're here talking about it today is the evolution and interest rate on gold, which is a new concept for a lot of people. And when we take a look at that performance, that is the superior performer the entire 20-year window. Very conservative, 3.5% gold interest rate. But understand, we're talking about interest paid in ounces. So this isn't a dollar interest rate. This isn't like a dollar percentage dividend like the S&P 500 total return. This is ounces of gold, 3.5%. Well, those ounces in interest, as the years go on, the value of those ounces of interest are going up too. So that's when you get these runs where gold has a really impressive performance. You've got a lot more ounces now because of that interest. And that's where the performance really shows up. And you see in a 20-year window, a 2x of the S&P and just gold by itself. Now, I can cherry pick a lot of different time windows. Again, I just pulled out a 20-year window, 25-year window. Gold by itself drastically outperforms the S&P 500. Some other time frames in 1972, just when we came off the gold standard. If you look at a gold compound annual growth rate since 1972, it's 8%. The S&P 500 total return outperformed 10%, but then you look at 2000 to now, and gold's the outperformer. Again, this is just the price of gold and not the 3.5% interest rate I'm talking about.
I love the time frames and perspective on that. I've always made note of the fact that I can make any numbers look any way I want them. Just pick a different time frame, and
Right.
I can
Pick a
prove
different
my
window.
point. Utilizing investing history obviously doesn't guarantee the future, but it's also because of the fact that you can pick any little chunk of time. I've always used from 2000 to today, and
Yeah.
very similar results to this. So, when did investors really start buying gold?
Yeah, so that's another window we could pick, Scott. We could 1975, so January 1st of 1975 is when it became legal again. So FDR in the 30s made it illegal for you to own gold as an investment. They still allow the numismatic coins, but just gold as dollar bullion, you couldn't own until 1975. So that's a good point. That's another window that we could choose, and gold drastically outperforms, you know, when you're looking at different time frames.
Yeah.
So one of the things that's the real driving force, you see that big increase in the price of gold over the last few years. One of the driving forces behind that has really been central banks So the Federal Reserve is a central bank. We're talking about the Bank of China. We're talking about, the Russian central bank. Some central banks all around the globe have been buying gold over the last, well, this chart starts in 2010. I mean, keep in mind in the 90s, the central banks were net sellers of gold. Well, they flipped around, and especially since about 2021, just after COVID, holy cow, look at the purchasing that these central banks have been doing, over 1,000 tons every year. Last year was a little shy of 1,000 tons. But there was even a bunch of buying during COVID. About 300 tons central banks bought during the COVID disaster. So Russia, China, and India are the real driving force behind this. But just in the last, 2, 3, 4 quarters, some of the smaller central banks around the globe have started trying to catch up, buying some more gold. So the first quarter of this year, we're on pace for another 1,000 metric ton purchasing year out of the central banks. So yeah, that's a big driving force of what's so many times, especially when we're talking about commodities, the prices moving up or down, and especially when aggressively up or down, it's the players on the margin. It's the demand on the margin when the price is really going up, and that's been central banks largely over the last few years.
So that's a crazy amount of wealth getting gobbled up by central banks. Where's the gold coming from? What are the production numbers?
Yeah, that's a good question. I mean, the production numbers have been relatively flat over the last decade in that 3,000 to 3,500 ton range. So when you're talking about central banks are chewing up a third of that, something like that, it's an absolutely voracious demand. So that's a good point to bring that up, Scott. And the production being relatively flat, there will be an increase in production. But starting a new gold mine, you're talking about from finding the gold, getting all the permits. I mean, even in the third world to actual production of gold, you're talking 15 years. So the supply and demand doesn't turn on and off real fast with these things. And
Well, absolutely not, but I'm sure the production goes up as the price goes up because it's worth more.
oh, it's going to go up.
Yeah.
And it's funny when the further you look into gold production and you see in the Western world and in the developed world, how the real obvious deposits of gold got chewed up decades ago, maybe 100 years ago.
Yeah.
So yeah, the supply will increase, but it's not the kind of, not like growing corn and soybeans with the price tripling, the production would triple in a couple of years. That's not how gold works. Well, so the demand is a little past just the central banks. That sort of 1,000 tons a year is a little bit crazy. Look at ETFs and mutual funds. So this is, and Scott mentioned this a little bit at the very beginning of our presentation. Individual investors, a lot of the purchasing of gold has been through ETFs on the New York Stock Exchange. So GLD started, I think that was 2004 or 5. GLD started, and it's basically buying gold, but through your Schwab account, making it a lot easier. So you don't have to find a coin shop and some guy spinning a sign, go buy some gold from him. So that demand, has really picked up as well, almost 800 tons last year. That's pretty impressive. A lot of the high profile investment managers are just in the last year, 18 months, have really been banging the drum that gold is a necessary part of everybody's allocation. Ray Dalio is really famous. He's been banging the 20% of your portfolio should be in gold drum. David Miller from Catalyst. So there's a lot of talk about it. So last year, State Street did an analysis of thousands of client portfolios and showed that among the investors that had gold, the average allocation was about 3.2%. But you were just over half the people that even had gold. So if people are going to be listening to these pundits, 10 to 20% of the portfolio is going to own gold. There's a lot more retail purchasing that's going to be coming at us. So last year, also, Wisdom Tree surveyed thousands of European investors. 41% of them responded that gold was their choice for saving purchasing power. But that same survey, only 5.7% of people's portfolios has really been allocated to gold. So there's more and more of an increase in the demand, and that's going to keep coming.
What about silver?
Um, Good question. So the short answer is silver demand is rising a lot as well. The big difference being the real big demand in silver is industrial rather than central banks. There has been a really big increase in investor demand for silver, but it just doesn't have that central bank demand. That's the short answer. I can, at the end of the presentation, if that's still a question, I can go a little more extensively into that. So here's the thing. So what we're talking about is an evolution within the gold and silver, thank you, Scott, marketplace. So the financing using gold and silver, this is expanding exponentially. So this part is nothing new, where gold and silver are money. Through all of recorded history, they've been money up until the last few decades, thanks to the British and American governments. So gold leasing and lending, central banks, bullion banks have leased their metal out to earn an interest rate. This has been going on for decades. The thing is, when you investigate what central banks were doing, you can't really tell what it was. I mean, it was very opaque. Individual one-off transactions that really didn't look much like a lease. It looked more like a loan with a lot of risk that nobody was disclosing. So what's changed in the last decade is a standardized and transparent platform to bring lenders and borrowers together outside of central banks. Normal, everyday private investors like you and me are now congregating.
Chat, yes.
Grayson, can you hit mute on everybody?
Yeah.
So, you got that?
Yep.
I'm gonna have to unmute myself, so.
No, you're good.
Okay. So how long ago did this standardized marketplace go about?
So I found them 8 years ago, and the origin of it was really 2016. So it's in its second decade.
Gotcha.
Yeah, the important point is this is a marketplace with the decision making coming from market participants rather than being dictated by a central bank. The market dynamics are telling you what the interest rates are on these leases and loans and what the terms are on these. It's a free marketplace. So it's not an opaque central bank lending out public gold. And that's exactly the point. An opaque market has really turned into an accessible and structured, transparent marketplace. So what I always like to suggest to people is to think in terms of ounces. If you're participating in a marketplace like this, that portion of your portfolio, think in terms of ounces. So you're earning an income in ounces on your ounces. So yes, it's denominated in gold, and you can, of course, you turn on CNBC, you're going to see the price of gold per ounce, and you can do the calculations in your portfolio, or the marketplace will have a system that shows you the dollar value of your holdings. But the point being, if you're earning more ounces the entire time, today's market value in US dollars really isn't that big of a concern to you. And you don't have to sit there and try to time the market. If you're making money To utilize that money, you can sell the interest and go on vacation if you want. You didn't have to touch the principal. Well, if you don't have a mechanism like earning interest on your gold, well, now you're dependent on, well, how do you make money? You have to sell when the US dollar market price is higher, and then you're back in the dollar matrix that maybe scared you into buying gold in the first place. So the key is to think in terms of ounces, and as long as you're aggregating more ounces, then you can sell some of the ounces to harvest some earnings if you like. So just to explain a little bit the different type of financing vehicles that are offered through the marketplace we're talking about are leases and bonds. So a lease is a situation where businesses that have a gold and or silver inventory just for working capital within their business. Obvious example is a jeweler. Well, their inventory is really, really expensive. And now they have price risk. So if the price of gold and silver are getting volatile like they have been the last few months, a jeweler is kind of at the whim of a marketplace to make money. But if they decide to lease the gold and silver that is in their jewelry, essentially investors own the inventory, and the jeweler just pays an interest rate to be able to use it. And they're making the margin over the market price of gold and silver every time they sell it. So look at this very analogously to if you had an extra house that your kids just moved out of or whatever, and you're leasing it out. Somebody's paying you to use your house. It is still your house. If they're not making their lease payments or rent payments every month, you get them out of the house and it's still yours. Exact same thing is going on in the jewelry industry, in the bullion industry. These refiners have a metal inventory that they don't have the capital to purchase. So the metal that we're leasing out to these companies is held as an inventory, a work in progress, so to speak. And the important thing, again, there is the fund. We are maintaining ownership of the gold, the ounces of gold, the entire time. And these are shorter term transactions that can be adjusted as the years go on. Now, another financial vehicle that we're participating in with our fund, but what's available in the marketplace are bonds. So this is no different than if you logged onto your Schwab account and bought a Coca-Cola US dollar denominated bond. You're lending a company capital and they're paying you an interest rate to use your money. Well, with the gold and silver denominated bonds, it's almost exclusively mining companies. So they need capital to get more gold and silver out of the ground. They would rather have their debt in the same currency, the same denomination, gold and silver, as their income. What they're dragging out of the ground is their income. So now that limits their price risk. It really mitigates their price risk, because if they're borrowing dollars and then they're pulling gold and silver out of the ground, well, this takes years. And what they're pulling out of the ground, the US dollar price might fluctuate drastically and they still owe dollars the entire time. So now they have price risk. So it gets really complicated. I can go into in a different presentation, but the banks that are lending these mining companies in dollar terms, they're forcing them to short sell in the futures contracts of gold and silver to try to mitigate some of that price risk. Well, if they're borrowing in gold and silver terms and the interest they're paying is in gold and silver terms, the price risk is effectively gone. So that's what we're utilizing as far as higher yielding investment vehicles. Because remember, we're loaning these miners gold and silver. They're selling the gold and silver for US dollars to buy trucks, to pay payroll. The gold and silver are gone. Now, we're doing the underwriting, we're doing the risk mitigation to make sure that these companies are competent enough to pay us back in gold and silver terms, but higher risk, higher reward. I hope that makes sense.
So through any of this process, whether it's leases or bonds, are there any guarantees? What securitizes or helps protect these investments, whether they're leases or bonds?
Really good question. So the leases are very low risk from the perspective that we're maintaining title to the metal the entire time, and there is insurance at every step of the way. Even on a lot of this, a Lloyd's of London sponsored insurance umbrella over the top of the entire transaction. So even if there is theft, there's insurance behind it. So those leases are very low risk. The bonds, now understand that mining companies have been borrowing it through bonds, have been issuing bonds for decades. So there's a history to this. Most of these transactions went on in US dollars. The difference is we have a built-in hedge with ours, but the risk is largely the same. So what is backing the investment that we're making? Well, essentially, if the mining company goes bankrupt, we own the facilities. We own the pile of ore that has gold in it. We just have to figure out how to refine that and get the gold out. So when you look at the history of transactions like this, an absolute worst case scenario, salvation value has typically been 60 to 70% of the original investment. So a long-winded answer, what's backing our investment when we're using the bond side, when we're using those instruments, it's really the facilities of the mining company that we'll own in the case of default.
Okay, great.
So this marketplace using gold and silver as the financial instrument in transactions, this is absolutely exploding. The demand is literally hockey stick, and that's because I'm going to keep this part of it short. Especially the jewelers, refiners, industrial users of these metals, how they've been getting their capital historically has been through banks, and they've been forced to hedge. It's been quite apparent that the gold on gold leases, silver on silver leases that we're involved in through this marketplace have been superior investment products. But a bunch of these companies, maybe they have relationships with bankers, financiers for decades. The marketplace has been growing with the leases that we're utilizing. But what really happened in the last 6 months is the huge volatility in gold and silver. And these guys haven't been able to lay their price risk off, and they've gotten killed. So borrowing, leasing in dollar terms and trying to lay the price risk off because they have so much gold and silver, it hasn't worked for them. They're throwing their hands in the air and saying, hey, give us these gold on gold, silver on silver leases. So it's absolutely exploding. The market participation, so not just the demand from the user side, but the market participants, people realizing that there's an interest rate on gold and silver again, trying to deposit metal and get a rate of return on their metal. The market participation is really expanding from that perspective as well. So the marketplace of leases and bonds denominated in gold and silver is really getting deeper and more resilient, and it's developing these capital markets. So one big thing, kind of a side point, but not really. When I'm talking about the demand for leases, the companies that are using gold and silver and the price risk has gotten a little bit crazy for them with this volatility. Imagine being a mining company and wanting to issue new bonds. A gold miner that owns a bunch of facilities that maybe they've never tried to produce gold off of, because with gold at $2,000 an ounce, maybe the numbers didn't work out. Gold at $4,000 an ounce is a different animal. So a lot of these mining companies really want to expand, but they want to be careful. So a built-in hedge, so they don't have price risk, borrow in gold and silver terms, pay interest in gold and silver terms, some of the production that they're gonna drag out of the ground, that demand is really rocketing as well. So regulatorily, structurally, this marketplace is really developing quickly. Yeah. Once
There
was
any
kind of a niche market,
there any big
really going
name
institutional.
companies we would recognize in this, Grayson?
Yeah, so that's part of what I'm talking about too, with the further establishment of the depth of the marketplace and the expanse of the marketplace, and this is going globally, right? But really interesting, the marketplace we're involved with, monetary metals. They're in talks right now with Costco to do a lease. This may not people may not be aware of it, but Costco sold about 1 million ounces of gold last year. So imagine being the purchasing manager at Costco. And for 2026, you had to buy 1 million ounces of gold as inventory. That's a $5 billion capital outlay. That's a huge capital outlay. And then if you buy at the wrong time with the volatility of gold and silver, now you've got price risk. And that's the really important, even a retailer like Costco, the price risk, yeah. I mean, think about it. Costco, maybe they spend $500 million a year on blue jeans, and it sits in all their Costcos around the country. Well, there's no secondary blue jean market. No customers coming into a Costco saying, "Hey, the blue jean market got killed last week. There's no way I'm paying that price. You guys got to lower the price of these blue jeans, or I'm not buying." It doesn't happen, but that's exactly what happens when they're trying to sell gold and silver. So Costco has that price risk. They recognize it, and they're coming in looking for a lease. So that's a big one. Another really huge one is the state of Utah. So the state of Utah is putting legislation together to start charging mining companies taxes in ounces of gold and silver. And then they're going to start issuing bonds. So imagine the state of Utah issue. This isn't a done deal yet, so just keep it on your radar. But imagine the state of Utah issuing bonds denominated in gold with an interest payment in gold, because they're going to have a gold income taxing the mining companies to cover it. They don't have any price risk. Do you think the state of Utah would be able to finance all their operations that way? I think that issue of a gold bond from the state of Utah would be oversubscribed a little bit. I don't think the interest rate's going to be too astronomical, because there would be so much demand from the investor side of that. Does that make sense, Scott?
Absolutely. Yeah, it just kind of shows that how ingrained in the system this is becoming. There's a lot more going on than most average people think there is in terms of lending and
Yeah.
utilizing of gold in the financing world as a currency.
Yeah. Well, and I don't I should know the number, but it's at least 20 states have declared a gold and silver legal tender, so there's not a
Yep.
taxation on that from the state level.
Yep.
I'm telling you, if the state of Utah does this, Wyoming, Texas, they're going to be right behind them, and this is going to
Absolutely.
get absolutely ginormous.
Yep.
So something to keep in mind. So our solution, we're describing the marketplace where, hey, there's an interest rate on gold and silver again, everybody, and trying to explain the dynamics of that marketplace. Well, the solution we've put together is the GoldRush Yield Fund. So we launched this in June of 2025. So June 12th, 2025, we launched. We're not taking a lot of risk, guys. The overwhelming majority of our fund is in these leases that, like I said, I mean, there's even insurance backing it. We're maintaining ownership of the gold the entire time. So the majority of the fund is in leases. But putting an institutional structure together, putting a fund structure together, we are getting opportunities on the bond side that average investors don't get. So we have participated in 2 corporate bonds after there was a big de-risking event on both of the publicly traded companies. we had the opportunity to come in, and one of them at a significant discount to par. So we can participate in the bond side of this. And I've got two mining engineers that are helping me do the underwriting and risk mitigation side of it, because the numbers make sense to me. I just don't know the logistics of mining. But we've got people on payroll that do. So we're mitigating the risk very well. So the difference between just the price of gold, the lighter gold line you see on that chart, and our GoldRush yield fund, the heavier gold line there, the 5.36% difference just in 9 months, that difference is going to keep expanding.
Yeah, it's funny. I run similar charts when I'm doing say compound interest versus simple interest.
Yeah,
And at 9 months, you cannot see the difference.
yeah,
So to
yeah,
see the difference already in 9 months, you can imagine 5 years from now and the compounding of growth on this. So the 5.36 is ounces of gold, regardless of the price of gold. So we're
yeah.
growing the amount of ounces that everybody owns in this portfolio.
Exactly. If you
Um,
started in this fund with 100 ounces of gold, now your account has 105.36 ounces of gold after fees. The dollar value of that is going to fluctuate, but we have no control over that. And remember what we're doing, we're not trying to time the gold and silver market. We're not trying to play the gold and silver ratio that you might hear people, pundits talking about on the internet. That's not, we're not speculative at all. We are deploying gold and silver into financing opportunities, financing profitable companies, and we're getting paid interest to do it.
Yeah, I like to describe it as the buy and hold. This is an allocation to your portfolio that is a long-term investment to help diversify the average portfolio, but also as a currency and inflation hedge as well. And so you like to talk about this as a currency, but it's an uncorrelated asset in a portfolio, which can be the best of all best. Diversifiers. That's what you're looking for, is uncorrelated assets to invest in. So
Well, yeah, that's a really good point too. I mean, a lot of people look at, oh, well, if the central bank keeps printing all these dollars, stock market's going to go up, gold's going to go up, bond prices of the bonds will be risky because inflation's going to be running and all that kind of stuff. Yeah, some years that's true. Some years that's not true. Some years gold and the stock market go up together. Sometimes they go down together. Sometimes they go opposite directions. Sometimes the point being, in general, there is not much of a statistical correlation between the metals and your bonds and your stock. So it's a true uncorrelated asset that when you're diversifying your portfolio, it makes sense. Again, guys like Ray Dalio are banging the drum for 20% of your portfolio in gold. Whatever you think of that, the reality is some of your portfolio needs to be in gold. And if it is, why wouldn't you want to earn an interest rate on it?
absolutely, it's far superior to any other options out there.
Agree. So just the structure of the fund to make sure everyone understands it. This is a private fund. Just because just because we are not registered as a full mutual fund doesn't mean we're not regulated at all. We are, but it's a private fund. We've got a third-party fund administrator, sends out everybody, here's your monthly statement. Here are your tax documents if you get a 1099, K1, that kind of stuff. Our bank is CIBC Bank, which is a big commodity influenced bank in Chicago. We have the capacity to protect downside risk in the price of gold and silver, and these are the brokers that we use to do it. The monies, whatever step of the process that we are in, these are the custodians of our assets. We've got a third party. We have to have a third party audit of the fund, and that's coming at the end of this year. It's a limited liability company. We do have a 1.5% annualized management fee, but we're not taking a performance fee. We do lock the assets up for 1 year, and people can ask for a quarter of their holdings quarterly after that. We have a minimum investment of $250,000. Right now, we're a little over 45 investors with a little over 12 million, but the capacity is huge. Again, this marketplace is blowing up, and we are on the very front edge of it. So let me pause there. Scott, did you have any finalized comments before I turn this over for questions?
Well, can anyone invest in the fund?
Yes. So good point. So this is a private fund. So everyone has to be an accredited investor to participate, which means you have to have a net worth of $1 million of investable, basically your net worth minus the house you live in. Or you have to have $300,000 of income over the last 2 years, 3 years, and that's expected to continue. So that's the hurdle to get over as far as an accredited investor, which you have to be to participate in a private fund.
And are there options for non-accredited investors?
Yeah, so for less than $250,000 and or non-accredited investors, yes, we have solutions where people can participate in gold and silver, and
Just not in this fund.
that's correct. That's correct. So
Got
type any questions that you have into the chat box if you like. I did want to expand just a little bit more when we're talking about gold and silver, because historically gold has been the financial asset, silver has been more of an industrial asset, at least since the Industrial Revolution. But the crazy part that's changing, there's a reflexivity in demand for these assets as the price goes higher. And let me explain that. So when I'm talking about an example, a jeweler, their inventory has gotten so expensive. The price of gold and silver have gone up so far that if there's an industrial company, just to draw a parallel, if they have a gold inventory that they have to have because they're consistently using gold in their processes, one of the earlier leases that I participated in was an industrial company that was spreading a really fine gold film on glass for industrial usage. The gold that they always had to have for their processes was so expensive. Of course, they're going to lease it. Why would they want to spend the capital and then have the price risk? They'll just pay somebody 5% to use their gold and always replace it all the time as they're spraying that film. Well, now when you try to draw the analogy with all these silver industrial companies, well, when silver was $20 an ounce, and these guys are using 1,000 ounces of silver a month, it's 20 grand a month for an industrial company. Maybe not that big of a deal. But if they wanted to expand, use 2,000 or 3,000 ounces of silver every month, and now silver's $80 an ounce, now all of a sudden, whoa, that's $250,000, right? I mean, the numbers as these assets go higher, silver especially is starting to catch up as more of a monetary instrument. And that's one of the things that we've done as a fund is we are financing an international commodity company with a 90-day line of credit denominated in silver, because the dollar price of it's gotten so high that there's more of a demand for it as a financial asset. So, again, as far as the ratio between gold and silver, we're not sitting around trying to speculate on that. I need to buy a bunch of silver in the fund because the ratio is going to go back all the way back from 80 to 1 all the way back down to 15 to 1. So sell your gold, buy some silver. We're not playing that game. The best of the financing opportunities that are presented to us, whether they're gold or whether they're silver, that's what we're going to make sure that we have the metal to participate in. I mean, the silver bond we bought is a 12% yield. The gold bond that we bought is a 20% yield. So we're looking for those good financing opportunities, and gold and silver are the financial vehicles we're using to participate. So I
The
hope
vast majority is in gold, correct?
right now the vast majority is in gold. Our fund, I mean, just the opportunities available in the marketplace are a 12 to 15 to about a 12 to 1 gold over silver as far as what's available to finance. And then that's about where our fund is also. We're not participating in every single financing opportunity. We are cherry picking. But yeah, we're about 12 to 1 gold to silver.
Great.
What other questions do we have?
Feel free to unmute yourself and ask questions. Don't be shy. We're going to hang on here for another minute or two and answer what questions come in, and then we'll let everybody run off to dinner.
Yeah, so another question I get a lot, Scott, is where are all these companies? Where are all the financing opportunities? And like I say, I talked about the jewelry in the Middle East because there's such wild demand for that right now, and that's really driven because whether we're talking about Singapore, Dubai, Bangkok, Vietnam, all over there. Investing to a lot of people in the Far East is buying jewelry. And with the price volatility of gold and silver, tons of demand for the leases coming out of there. But India is absolutely huge. There are a lot of British companies, bullion companies, that are coming up right now. Some of these international jewelry companies will have American subsidiaries, or maybe it's an American company with a subsidiary in the Far East. Again, Costco's coming in looking for a lease. So this is really exploding around the entire globe. And right now a little bit more concentrated because Dubai has become the world center of gold in the last few years. Taking the mantle from the Brits in London. But yeah, this is a worldwide phenomenon. The Chinese are building gold depositories for a lot of their trading partners all around the globe.
Yeah, the BRICS nations have been really pushing all of this. Just to dive off of that real quick, in a more practical sense, we had a great question come in from Mark. What about investing in the fund with, specifically, he stated a self-directed IRA, but an IRA in general?
Yes.
I just want to make sure it's that we do have a very clear black and white answer. Investing in this fund with a Roth or an IRA, can we do that?
The answer is very simply yes, we can do that.
Absolutely. So, Mark, the answer is yes, IRA money can go into the fund. Third-party custodial reporting agency gets involved with any qualified accounts like IRA or Roth, but we do have lots of IRA in this account.
There is one extra hurdle.
Yeah.
But again, we've been doing this 9 months now, and we've got that really streamlined. So that's a very simple yes answer. And I encourage it. I encourage Roth money.
Yeah, it eliminates the taxation on it. It's great.
Yeah. Yeah, and let me make this point too, Scott. Maybe a couple more questions will come in. So Mark's got a follow-up question. What are the options of starting with less than $250,000? And yeah, Mark, that's more of a conversation that you and I should have. So I'll make sure that I get in touch with you to answer that question rather than
It,
just
yeah,
broad lines.
part of that answer is it does matter how close to 250. An
Well,
exception can be made if you're close, but there certainly can be some other options depending on how much.
yeah, yes, then
Yeah.
we can go to other options. Um, so yeah, then I got sidetracked on what my other thought was.
Well, we were talking about international trade starting to create transactions in gold. Ultimately, that's where you were going with the banking system. The BRICS are putting together. Um,
Yeah, and some international trades are actually getting conducted in gold and silver now. And that's only gonna we're actually providing the silver for some of that with StoneX. Um, so that is actually going on. That will continue to increase as well. What the Chinese are doing is not so much, the Chinese really want the yuan to be the world's reserve currency. They're just not realistic about how they're going about that. So at the end of the day, how it's really working out is perfect example. So the Chinese buy a lot of soybeans from Brazil. They're 10 years ago, if they were buying soybeans from Brazil, they would hand them US dollars. And they would hand them the US dollars that they got from us, from all the stuff we buy from the Chinese. Now the Chinese are trying to spend yuan. So they're giving the Brazilians yuan for their soybeans and telling the Brazilians, hey, you guys hang on to those. You want to give them back to us and buy some of the stuff that we make? Hey, that's great. If you don't want to, just hang on to them. Oh, you don't really want to hang on to them? Okay, we're going to build a gold depository for you guys on your sovereign soil. Now, that hasn't officially been stated that they're going to do that. That's my guess. The next one is going to be Brazil, but they've got them going up in Singapore. They've got one in, well, they're collaborating with the Russians to build one in St. Petersburg. They're building them all around the globe, and they're essentially backing these trades with gold, telling the Brazilians, okay, you don't have to hang on to our yuan. Go ahead and buy gold. We're not going to guarantee the price the way the Americans used to guarantee a US dollar price of gold. I'm not going to guarantee the yuan price of gold. You're buying it at market prices, but we'll build a depository for you, and you guys can go from there. Any other thoughts or questions, Scott? I don't see any others coming in. I can't think of anything right off the top of my head, but we'll keep doing these presentations and discussions quarterly. So be on the lookout. My contact information is on there, so feel free to reach out. And yeah, thanks for taking the time to sit with us today.
All right, Grayson, I appreciate it. So again, these are going to go out quarterly. We will record them. They will go on our YouTube channel. Look out for those. Certainly contact us if you have any questions. You've got the AndorraCapital.com website on there, but you can also reach Grayson and I through sesweb.net as well. That's our advisory firm that we have together as well. All right, Grayson, I appreciate your time. Thank you for sharing your expertise. And we will see everybody in another quarter.